The Hedgeless Horseman here for the second time, December 29th, 2023. First of all, thanks to the sponsors. I thought I would make a video where the theme is, let's call it a New Year watch list. Before I go into that, I think it's a good thing to keep in mind that you want to pick up as many tools and concepts, etc. Learn as much as you can about this, how this sector works, how people work, how companies work. Okay, so in the last video, we went through the fact that, yes, we've been in tax loss selling silly season, and that's a thing. That's 100% a thing. That basically stuff that is already down and probably cheap simply get cheaper and cheaper until the tax loss silly season is over. That's an obvious edge to know that. Instead of, being like most people that, this stock I thought was cheap, it's down 30%, that must mean I'm wrong. It's like, no, that 30% probably is driven by someone who's selling just for the sake of selling since it's already down on it. And if you get a 30% discount for no other reason than people actually, the reason they're selling is simply because it is down already. So it doesn't really matter if they sell and it's down even more. They're going to use the tax loss for tax purposes. And if a store is intact or whatever, it's like minus 30%. A lot of people will see a paper loss as something bad by default, which makes little sense. Because volatility is, one second, I gotta close the window. Volatility is one of the main currencies we have, one of the main tools we have. So, and I've talked about this before. Imagine you have a 3% position in some stock, and you think it's really, really cheap. It goes down 50%, so you only have 1.5%, and you're taking a 1.5% loss to your overall portfolio. On paper, for a time, maybe all of a sudden that stock, thanks to tax loss silly season, went from cheap to super cheap, and you shouldn't have a 3% position, which you started out with. Now, thanks to this negative volatility based on artificial selling, you should have 6% exposure. So the position goes down 50% in price. Maybe you should quadruple your exposure in that stock. And at the end of the day, once tax loss silly season has ended, and let's say your base case plays out, whatever, that 6% position might, who knows, let's say it doubles over the next year. That's a pretty good outcome. So that's the thing, first and foremost. Like, just knowing about tax loss silly season, that's one thing. But another concept, or how this sector works, is that companies typically wait to, especially again, if it's late in the year, there are holidays and tax loss silly season. So if you release positive news, that might be met by a wall of artificial tax loss selling. And it doesn't really get any momentum going. And you know how it is, and we work like that as humans. We love momentum. If something has gone up, we want to buy more of it. If something has gone down, we want to sell more of it. And that's why most of us lose money. Because we do what everyone else has already done, kinda, instead of taking profits when everybody's chasing and buying when everybody's getting out. So it makes perfect sense from a management team's perspective to okay, we want to get some momentum going so we can hopefully get the share price up, so the inevitable dilution won't be as bad and everybody profits in the end. Same news, but let's say you put it out in a more favorable environment. So okay, let's say you have some positive news coming or in the works. I mean, you could, let's say, strike a deal or whatever in November, December, but the sector is totally shit, which was in November. Then we're into holiday season and at the end of tax loss silly season. So okay, you have sentiment is shit, which makes people not want to buy. People don't like to buy cheap. That's just how it is. There will be a lot more people wanting to buy once this sector is up 100 200%. That's how it is. That's how it always is going to be. You have tax loss selling that's going to weigh on any positive news, basically. I mean, it's going to might be met with a lot of selling, people taking profits, or again, just because the sentiment is so bad, people want to get out of the sector. So wouldn't you rather start the new year? People are back from holidays, everybody's back to work, back to watching the markets, yada yada. People are a bit more hopeful, a fresh start. Let's see, I mean, that's why there's such a thing as New Year resolutions. People want a fresh start. People have the belief that, hey, I can become a better person this year. I mean, it's like a reset, and I think that goes for portfolios as well. That if your past year has been bad, you still think that, hey, maybe this year will be the year I change things for the better. It's like, okay, I'm gonna really focus on investing, because obviously if you sell out, it's very hard to improve your investing. So it's like, I think there's gonna be typically a boost in terms of wanting to invest, simply because even if you had a crap year, it feels like you have a clean slate, if you know what I mean. We go again. And again, you're out of tax loss silly season, so that artificial selling pressure is gone, etc., etc. So what other time would be better to release positive news than people have, let's say, higher expectations of the future, a bit more risk on, a bit more likely to actually be buying, investing. They're also at their computers because they're not how do you say it, distracted by family gatherings and parties and all of that. No, so it makes perfect sense why there should be, and typically is, a backlog of positive news. Not only is there a backlog of positive news typically, but also the reaction to said news ought to be better than having released them in November, December, especially in a crap year like this. So that's a twofer. More positive news than usual, just because it's after tax loss silly season and a new year and all that. And the reaction to positive news tends to be higher on average because, again, new start, fresh start for people. People want to, try to make it this time around. And also because we are past the artificial selling pressure. So what I'm trying to say is that I think it's very good to be paying attention come, New Year, January. So, okay, so with that in mind, I mean, I hope it makes sense. And again, this is something if you should have with you every year in this sector. That every year you know how tax loss silly season work. You'll get, especially if it's a bad market, you're gonna get better bargains than you should, because people are not selling because they are overvalued, even if they have a sense of value investing, but they're selling because of tax reasons. So you get typically the absolute best returns come from tax loss silly season, future returns, because they are driven so low. Also the fact that companies tend to want to release positive news in the new year. That's why it's like the person, the ex-junior investor I highlighted in the last video. I mean, I think it's even more of a shame or a tragedy kind of. That's like you sold out at very, very cheap levels at the end of tax loss silly season when you have the new year just around the corner. So you sell when it's artificially cheap. and when the backlog of good news is the highest, perhaps higher than any other month of the year. I mean, when you think about it, it makes me nauseous. It's like you can't come up with a worse strategy, in my opinion. But anyway, so I just thought like, okay, let's think about a few. I mean, there's a bunch of companies that might release positive news, of course, but I don't hold or know about every single junior out there. But I think these are some that are interesting and I personally own, so I know something about them. And some are sponsors as well, which makes me twice biased. Oh, this shouldn't be. This should be. I know something about it. Okay, one of the ones I really like, Alamira Gold. 29 million market cap. Okay, so what's up with Alamira? Well, they have started drilling. Let's see, where is that? Yeah, so they have started drilling. They started drilling 5th of December. I don't know how long it takes to drill or how long the assay turnaround is, but I think they're doing relatively shallow holes here. So these are some of the holes they've already drilled, and here you can see some of the assays. Like 1 to 7, I guess 6 wasn't that good, but like 1 to 7, excluding hole number 6, which is here. I mean, given how shallow they were, yada yada, I mean, these are good results. I mean, starting at surface, 50 meters or 1 gram per ton, 55 meters or 1 gram per ton, 50 meters or 1.1 grams per ton, 69 meters or 1 gram per ton, almost at surface, 71 meters at 0.6 grams per ton. And they've done preliminary metallurgical results as well, which looks very favorable. I mean, and look, this is their drill plan, whole programmed. So we know there's a lot of shallow, decent grade gold with probably good metallurgy. I mean, this would probably be super cheap to mine, very profitable if you have 1 million ounces here, I think. I mean, close to surface, metallurgy is good. Brazil, where you can build a mine, etc., etc. It's like, okay, we don't know how many holes they've drilled, but we can see the footprint here. I mean, they're doing a carpet bombing campaign. I don't know if they will release like 3 holes at a time, or even, do they have any assays yet or whatever. But relatively short holes, maybe assay turnaround isn't that long. So this is one I think could have that. I mean, there's potential for that kind of quantum leap kind of thing. If a load goal explorer drills, I don't know how many the holes they're planning to drill, but let's say 30 holes. I mean, you can't say much. I mean, you can't 30 holes in a load goal system. You might know that, yeah, we probably have, I don't know, 30,000 ounces, something like that. I mean, if we're lucky and they get some good hits, like, I don't know how deep they will be drilling. I think they're doing relatively shallow drilling, just trying to find a footprint. But like, imagine if these holes here average like 50 meters from surface of 0.5 to 1 gram per ton gold. And, it's open at depth or whatever. We know that Aura Minerals recently took a stake. They got $6 million in the bank. They have 700,000 ounces already at their other project, which is not that far off. So they're starting with 700,000 ounces, and that system is wide open. They have a mid-tier as a backer, which got in, I assume, simply because of this project, because of these first drill holes. So, you know me, I like, the types of play, like, especially when it's early stage exploration, like Condor. I'm just gonna change one thing here. Condor and Snowland, where it's like you have potentially a big bowl of soup, and just with, let's say, 10, 20, 30 drill holes, you can tell a lot. You can go from like, we don't know we have anything, to like, okay, we probably have a million ounces, a couple of million ounces. That is extremely high growth rate potential for targets like this, disseminated gold systems, and it's very thankful. It appears to be starting literally at surface with pretty good grades. I mean, 45 meters, so 0.4 grams per ton, that's probably a cash cow. I mean, if they would find a lot more of that. I think this target here has the potential to be worth several $100 million. And we might have a pretty good clue if that's going to be the case after just this drill campaign here. And let's say they have assays, some assays, or they look pretty good. We haven't heard anything from ALTA. Okay, it's only been, I mean, they've only been drilling for 3 weeks. But I think I'm on the lookout for this one. And as always, there's no shame in like, yes, now we're taking, assay risk, obviously, because if they bomb on almost all the drill holes here, for example, and you're like, oh, it's, they probably don't have even, 500,000 ounces. I mean, that's not going to be great. I mean, it's not pricing in much. One could say it's barely pricing in their 700,000 and wide open gold target they already have, or gold deposit or resource they already have, plus they have a bunch of good looking porphyry targets. So I wouldn't even, I mean, I don't think a lot of success is priced in for Altamira at Maria Bonita, this Maria Bonita target. That's what I'm saying. And if these holes are good, they could prove up a company making deposit, or infer a company making deposit after these, let's say, 30 shallow holes. That's what I think. Or, but they might, the mineralization might extend down quite a bit, and they might only be drilling 50 to 100 meter holes. But who knows, if they put out 300-400 meter holes, maybe the mineralization goes that deep. That we don't know. I don't think they will drill that deep, but we're gonna have a pretty good sense. And I am not too much in love with pre-discovery plays unless they are de-risked in some way, and this is de-risking because they kind of drilled blind. Now they at least have more geophysics backing it up, and they're gonna do a carpet bombing campaign and try to outline out pretty sturdy. I mean, this is what, 300 meters, this might be 700-800 meters, whatever. So I mean, if they have some good results here, we might almost immediately know, yeah, this is probably going to be 1, 2, 3 plus million ounces. And then, given the grades, if the grades hold up, it's shallow, good metallurgy, oxide stuff, then you have a mine already. It's like Aura Minerals, the one who invested, they are putting, I think, mines in production with like 700,000-800,000 ounces of gold. If this is a multi-million ounce system, I think it could almost become their flagship target. So Altamira I really like, but again, as always, even if I think it's a no-brainer for me is not something I know I'm going to make money on. I have no idea what stock I'm going to make money on. It's all up to probabilities, etc. What risk am I taking buying at whatever, 29.6 million market cap? What's the upside? Obviously, I like the bigger the upside, the better, because if Blue Sky is 5 million ounces and they hit 2.5 million ounces, that might be a multi-bagger anyway. And since it starts shallow, appears to be good metallurgy. The critical threshold for success, if you have 1 million ounces here, I think you have a pretty good mine already. And that doesn't feel too far off. So I really like the risk reward in Altamira. Then we have like Headwater Gold. Headwater Gold. We are waiting for assays from... there's a lot of assays we're waiting for. I think this one, this is perhaps the most exciting one because this is pre-discovery. Midas North, just north of the famous Midas mine, which was worth billions for whoever it was, Barrick maybe. 9 drill holes, testing 6 target areas. That's pretty good diversification. Epithermal veining and alteration were encountered in multiple target areas across the property. Assays are pending. Is there a chance? This was 6th of December. You wouldn't really want to put out news before year end again. So I think there's a shot here that Headwater might surprise with something positive. Simply because we haven't gotten any news, and I would think that, I mean, if they have one good hole or whatever, they might release it or not release it. I mean, that I don't know. But here's like, I was gonna say, I mean, they had mixed results. That's how I would put it, and they Mahogany they kinda wrote off. Katie they kinda wrote off, and it's like that's not good news. Like it would be great if they had 4 projects or whatever that they're full on board encourage on, but they are very encouraged at Spring Peak. And again, Midas North is like the black swan kind of thing. I mean, if the odds are very low since it's grassroots exploration that they're going to hit a bonanza hole, even if there is a bonanza system there. But still, I think, I mean, the thing with this is there's a chance they make a discovery here. There's a chance there's more good holes coming from Spring Peak, and it's trading at 13.7 million market cap. I mean, that's nothing. This is one I own quite a bit of already, but I'm very interested to see what's going to come out of this drill campaign. I mean, in my opinion, Spring Peak alone, this is cheap based on Spring Peak alone, even if Midas misses. I mean, if they don't find anything at Midas, given how Spring Peak looks, that looks like it has some size potential. And for 30, I don't think it's even fairly pricing in Spring Peak. So the way I see it, kind of valuation-wise, is I get the shot at being in before a discovery hole at Midas, and I'm not even paying an evaluation risk for it. That's pretty good risk reward to me. Inflection Resources, I mean, kind of a similar story, same team behind it. They have sniffs at 3 different targets. They have found bornite, chalcopyrite, which is high-grade copper mineralization, at 2 targets. They have chalcopyrite and molybdenum at the 3rd one. So they have very interesting smoke at 3 porphyry targets. I mean, they have a lot more targets to test. They've written off a lot of targets. They also have the gold target up in where is that? The Karen Gold project. Anyway, let's see here. Let's see, first and firm. Yeah, I mean, the company is looking forward to follow-up drilling as well. So it's like they're probably drilling around the clock there in Australia. I just guess at least. But they did have an update fairly recently. Could there be a closely spaced? I mean, they had here they have just 2 days in between, I guess. And yeah, this was the Karen. All sample has been submitted for analysis and results are pending. So okay, we're in for obviously assay results from the smoke drilling at the porphyry targets, and we are waiting for gold assays from the Karen Gold project. The Karen Gold project, I mean, that might surprise. They might find a discovery. The thing with the porphyry targets, of course, is that they are very large and they are more disseminated in nature. It's like, do I think the current drilling, will that be, will they make discovery holes from the holes they've drilled so far? I don't think so. They're close to something, probably. But we don't know when, you get an update. I mean, assuming they just kept on drilling and they have an idea which way to drill, maybe they've drilled another hole or something. Maybe 2 holes. Who knows? And it's like, we get a news release saying that extensive chalcopyrite mineralization, whatever. And I think that's gonna, I mean, people who get the meaning of that, or they announce like, we're actually in a porphyry now, etc. I don't think the holes they've drilled so far, I mean, they have assays coming, but I'm not expecting, pure discovery holes from the porphyry holes that's been, described in this news release. But still, it's like assays coming and more visuals, let's say, coming. So this one I really like as well. High risk, high reward, not pre-discovery play. But the thing is with, I mean, especially I guess Inflection, given the size of their targets, I mean, if they end up hitting something, if they end up making a porphyry discovery, it's like 19 million. That's going to look very cheap very quickly. So that's the thing. I like these high risk, high reward stories. Diversification. I'm not all in on Inflection. Could this become a 10 to 20 bagger? Yeah, it could. But you want a lot of these stories. I mean, you just want to have to, let's say, look right on one and it pays for 5 others that went down 50%. Stuff like that. So it's like, I don't guarantee that Alamira or Headwater or Inflection will make company making discoveries, but I know if one of the 3 does, it's probably going to pay for the other 2 if they went to 0. As long as you hold the ones that actually succeed, because like I've talked about before, let's say Inflection makes a discovery hold. It pops up 100%. And you're like, okay, 100%, that's great. I almost have no, let's say I almost have had no stocks in the green. So I'm selling that on the double or whatever. But let's say it's a hold that's, good enough that this is probably just the start. This is signaling that they might be onto a $1 billion target or more. They would get 25% of it. It goes up to 40 million. I mean, that would still be pretty cheap in that case. So I think, it's bad from that sense, because we take so much, quote, assay risk. And if they're successful, we're leaving the train after, the first station. That doesn't make much sense. Because the thing with high risk, high reward, to get the high reward, you have to ride the stocks. But what I used to do, and I might still do that somewhat, and I see people do a lot of, it's like, as soon as they're in the green in some growth stock that's made a discovery, they think, I should get off now. It's like, that might be the start of something. Take Snowline or Big or whatever. It's like Big is Hercules Silver. That's up to 300 million market cap. It's gone up a lot. Still, if what is there, what people and Barrick hope is there, maybe it's going to go up 5 times more. I'm not saying never take profits, but still, it's like, if there's runway left, I mean, 300 million market cap for Hercules isn't really cheap. It's not like it's pricing in no chance in hell, whereas Inflection is more kind of a no chance in hell, but this is more risky though. Point being, if there's you should always look ahead. It's like, how much are you paying for the blue sky to play out? That's a thing. So this is definitely on my watch list. Hercules Silver, of course. I mean, they put out one hole in, I don't know when it was, October maybe. Then Barrick got in. We've heard nothing. Okay. That makes it interesting. There's like, it's just a big, long, quiet period going into tax loss silly season and into the holidays. I don't know how many assays should be in the lab by now. But if they're good, I bet they would like to hold off on releasing them for the new year. The question is, as always, what we don't know. There might be good assays, but maybe there's so many people expecting good assays that it's not going to be that big of a pop when they release the first ones. Or let's say they release good assay results, which shows that the story is very much alive. It's expanding. It's being de-risked, but the stock didn't pop. Is that a good or a bad thing? I mean, who knows? Maybe right now 300 million looks very cheap. Let's say 300 million looks rich. Let's say they put out good news releases, and you're like, well, I all of a sudden I think it's they have a shot at finding something worth 3 billion or something, and the stock doesn't move, and you think there's like a 30% chance of it being 3 billion. That should be trading at 900 million in that case. I mean, this might be an extreme example, but it's like, if the stock doesn't move, all of a sudden, yes, it didn't go up on the news, but all of a sudden it went from, I'm not sure, it's fairly early to, it's like, okay, that jumped in terms of de-risking. The stock didn't move because there were so many people who wanted to flip on the news release, but that by itself created a buying opportunity because the the risking and implied value jumped so much, whereas the price did not jump that much because people were just going to sell on the news release anyway. All of a sudden, you have a higher implied value floor. All of a sudden, you have an opportunity to buy. So who knows? I have no idea what the news is going to be, but maybe they release positive news. Market doesn't react because there's so much pent-up selling because so many people are planning to sell the news, that it actually creates a buying opportunity for the people who did not buy just for this news release, but they're buying this news release, what it says about the next 10 news releases, if that makes sense. Condor Resources, obviously, I mean, I'm so fascinating about this story. And not just the target and all of that, but I mean the Pucamayo East target, simply because I'm having so much fun trying to read the minds of the management team. And again, if we want max impact, they should release, I mean, positive news that gets released in the new year relative to right now. I think the new year will bring a much higher impact, maybe much higher impact to the downside as well. Not 100% sure, but maybe. But positive news is gonna favor positive news being released in the new year. That's for sure. A higher impact. And like I talked about recently, I mean, they have a huge portfolio of projects. I mean, I like Pucamayo, which they're drilling now, which is the main show. Andrea looks really interesting. Cobra Orco looks really interesting. I think this one is one of their favorite targets. So I mean, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. They got 12 projects. And the current market cap is, after this latest selling, 48 million Canadian. They got some cash. I think they have some cash coming in as well. If they drill pure dusters at Pucamayo East, that target is dead. Would that make Condor very expensive? Given their portfolio, I don't think so, because they have, to quote Quinton, several world-class targets. But is the stock going to sell off in that case? Yep, but is it, how much of a big long-term problem would that be? A paper loss? I mean, what I don't like is if there's no plan B, and I talked about this before, that if Condor only had Pucamayo East, I mean, personally, I think the market is focusing on one thing, that's Pucamayo East. I think if Condor had only Pucamayo, I think the current market cap would be somewhat similar, because that's how the market works. So I don't think a lot is priced in for the portfolio, or one could put it the other way, that if the portfolio is priced in, I don't think a lot is priced in for Pucamayo East. And this is also akin to like Snowline, Altamira in some sense, given how these that these might be, or probably are, disseminated systems. You have this extreme growth curve in case they make a discovery. In 30 holes, just like Altamira, with 30 holes in Pucamayo, they could infer multi-million ounce deposit in like 30 holes, potentially. So that's why the thing is with these, from a compounding perspective, you can't get much better than, porphyry targets, intrusion-related targets, or high sulfidation targets in the case of Pucamayo East. Because they are disseminated targets, and just a few drill holes can tell a lot. Just like what you saw at Hercules. One hole brought them to 300 million market cap and an investment by Barrick. One hole. You would never see that happen in a load gold system. An example of that would be Newfound Gold, which drilled, 19 meters of 60 grams per ton or something. Huge hole, which they kind of IPO'd on. Still, that traded 100 million and people call it overvalued. And they drilled somewhere around 500,000 meters. And people are still not sure, I'm certainly not sure exactly, how much gold they have. You don't need 500,000 meters at Altamira. You typically don't need that at a porphyry either. And especially not a high sulfidation system, as we saw with Pierina, which got acquired after just 9 holes. So that's what makes these projects a bit extreme and very sought after for a compounding growth investor like myself, because let's face it, and I've talked about this before, even if you think a load goal system has a shot of hosting 3 million ounces, if that takes 3 years to prove, costs you 40 million, compare that to a disseminated system which might take 1 year to prove, and the drill cost, the dilution you would need to incur would be like $5 to $10 million. Not only higher growth rate, more growth per meter dollar spent, meter drill dollar spent, you also have it in a much quicker time frame. That is, and I maybe it was some time since I talked about that, but it's like these are all concepts that I think is very, very, I mean, that will give you a real edge when you really, it's like no exploration story is exactly the same as another. So if you hear, it's like, well, I bought this because I think they have 3 million ounce potential, and I bought this because I have 3 million ounce potential, and at face value, you're sitting there thinking just, well, I should have, the same amount in both. But from a compounding perspective, I would much rather buy something that could go from 0 to 3 million ounces in a year than something that could go from 0 to 3 million ounces in 3 years. And with more dilution in the 3-year case. From a compounding perspective, if you could pick either one of them, you would obviously go with the quickest and fastest payoff for the lowest cost. So from a compounding perspective, the longer let's say if you string 20 cases with disseminated systems that could prove up 3 million ounces in 1 year, and you did that 20 times in a row versus 20 cases where you have load gold systems, whatever, the disseminated portfolio would, I don't know how much it would outperform it, but it's like, imagine every 1 year it goes from 0 to 3 million ounces, then a new one, 0 to 3 million ounces, 0 to 3. After 20 years have passed, I don't know how many ounces the disseminated portfolio would have added. And in the case of the load gold exploration portfolio, it would add 3 million ounces every 3 years. So 1/3 the pace with more dilution on as well. So longer to upside, to blue sky materializing, plus lesser of the upside being kept because there's more dilution. Huge impact. Absolutely. The more time you give those portfolios, the more the disseminated portfolio will outperform, because it's just going to compound. I mean, imagine one has a growth rate of 70 and the one has a growth rate of 30. It's going to be, I mean, in 10, 20 years, it's going to be astronomical, the difference in value creation and portfolio returns. Something to think about, I think. Magna Mining, they've been relatively quiet lately, but we know they have a lot of irons in the fire. That's one where you can really see the difference, and I talked about this in a previous video. You can see the difference. As soon as tax loss selling kind of went away, and maybe even the warrant holders got finished selling, it's like it just popped 50%. And on that note, actually, I did this after having done the last video. I think this is a great example. Just to hammer in the point, it's like you have to take responsibility. You cannot believe the bullshit being spouted by the 95% of people that will never beat a cyclical sector and never outperform an index, no matter how long you give them. It is not the market itself that will dictate your long-term results. That's decisions you make. So here we have, in this scenario, 3 people. They experienced the same bear market. three people make different decisions, and the three people will have vastly different outcomes. So you have, so all start off buying high. Okay, they all buy high. So everybody has the same situation to start off with. All had, let's say, bad timing. Okay, they bought the high. They're in a junior bear market, and it doesn't matter how long this is. I mean, 1 year, 2 year, 3 year, a month, whatever. It's like the same rule applies, and that's why I think it's also people have this expectations that I'm only gonna buy low if it turns within whatever. It's like, you sell out here because now you can't take it anymore, and it should be working already, and then a week later you have the actual bottom, and so you missed out because you couldn't hold out. Because I see that all the time. It's like, you said it was cheap for 2 years already or something like that. It's like, it doesn't matter. If it's cheap, it's cheap. It's not, I'm gonna buy cheap, but I'm gonna sell if cheap hasn't become expensive in 2 years. That's not how this works. But that's how people justify that. It hasn't worked out yet. I feel so stupid, or I look stupid for long enough now. Now I'm starting to feel stupid. I feel like a failure. My ego can't take it. I don't know what I'm doing, so I'm selling out. Anyway, back on track. So you have three people. Every one of these three people are on board for a 70% bear market. And that's quite typical in the junior space, I would think. But down here, when everybody's down 70%, and they don't know this is the bottom. So, I mean, I shouldn't have made it perhaps like it's, a clear-cut bottom, because, I mean, in reality it will be maybe something like this or whatever. Still, I mean, I'm trying to make a point here. So when these are all down 70% in their portfolios, all of the three people make different decisions. One gives up, buys high, sells low. So he sells out. His experience in the junior space is that he lost 70%. He lost $7,000 out of his $10,000 invested. He's out. He's not going back to stocks, he's out. So he got minus 70% from his investing adventure over maybe, let's say, 2-3 years here. Okay. We have one guy that knows at least enough that he probably shouldn't sell if the sector is the cheapest it's been in like 8 years or something. He at least knows that. I should probably not be selling. I don't want to sell down 70%. This is crazy. Or maybe I had a stroke or whatever. So he holds at least. And then you have the third person. He understands enough and has common sense enough and enough grasp of the obvious that this is a cyclical sector. There's 100% chance this is going to turn into a bull market one day. And when I look back from the top of the next bull market, I know I'm going to be happy having bought low. And the idea is obviously buy low, sell high. Or buy cheap. I don't like to say buy low because something being down doesn't mean it's cheap, but buy cheap, sell expensive. So he buys for $3,000 more. Not a huge buy, but he goes from $3,000 to $6,000. Then we have the inevitable bull market. It might take 6 months, a year, 2 years, I don't know, but we have a bull market. And it's not the most aggressive bull market. It just goes a bit higher, let's say, than the top here. I actually should have made this peak a bit higher, I guess, but it's not an outrageous bull market. It kind of goes back to the, like it's a trading range. Okay, what's the difference in outcome? They all experienced the 70% bear market. The difference is what they did around the lows. One sold, cemented a minus 7k loss, minus 70% is his investment return in the sector. The holder, after being down 70%, it went up 300%, so he made 2k. So he made 20% at least. Not I was going to say a huge gain, but obviously exponentially better than the seller who lost 70% of his money. Huge difference, multiples. This guy has $3,000 left, this guy has $12,000 left. 4 times difference, just from not selling but holding. The buyer, however, he takes a step up, he takes it up a notch. He adds for 3K more, and that's not an outrageous sum. But he doubles his exposure here. He sucks it up. He's looking at 70% minus in average of his holdings. But he deposits $3,000 and doubles his portfolio. He's gonna end up, even if it goes back to just slightly higher than when he bought in with 10K, he's gonna come out with plus 11K, which is infinitely better than the seller and much better than the holder. Yes, he invested 13K instead of 10K, but still, I mean, ideally you would want to actually, first of all, not start off just buying high, but I mean, that's again what I said before, that's like, it's very human to start off with a mistake. But what kills people is not, the bear market does not kill people, it's what they do that kills their long-term returns. I don't care where you buy. If you sell lows, it's like, it doesn't matter if you bought here and sold there and you're only minus 40%. That's still minus 40%. And you go into the next sector that's a bit hot and you do the exact same thing. It's what the decisions people do, especially at the lows, that's gonna dictate their long-term portfolio. If people keep repeating this, the seller always buys high, sells low. The holder only holds. I mean, he'll kind of go nowhere, I guess. But the buyer, especially, I mean, add in a bit of stock picking and reducing the, even if it's net buying all the way through, if he just ups his net buying near 50-week lows, etc. I mean, in the long term, the buyer is actually going to make money. The holder is going to, I mean, depending on where you are in the cycle, he might be up a bit, he might be down a lot, etc. But the buyer is the one that's actually going to beat the market. He's the one that's actually going to have good returns. Yeah. So and this, like from Aktersnurran here. Very true, in just a few trading days, 15 out of 20 buys last 6 months of averaging down is in the money. Looking forward to another year of buy low. So, I think this is a great example. Does this look sexy? Is this something you see people brag about? It's like, yeah, I actually, bought up here and I averaged down all the way. No, because it doesn't look sexy. The pictures people post is typically one buy here and then sold out there or something. But you have no idea what kind of position size there. You better believe it's cherry picking. Everybody's cherry picking. I've seen people post their highlighted, annual returns or returns from this year. I know some post, and you kind of just have to trust them on it. I mean, they don't show a graph. They say the returns, and I pretty much know, I can't even, I mean, if anything, they're exaggerating the returns to begin with. On top of that, you have no idea the size of the portfolio. They might be playing around with 10% of their net worth. They might have a bunch of warrants included. They might have, stuff like that. It's like my Hercules Silver warrants, for example. They went up a lot. But that's mostly, it's like, I was going to say, luck kind of. So, I mean, if I have warrants and you don't, we have the exact same portfolio, we bought cheap, my returns are going to look much better than yours. Even though we might have had the exact, kind of the same idea about every single company and almost had the same position size. But the warrants, I mean, they just supercharge any success story, especially if it's, like Hercules Silver. It's like, warrants at 11 cents, it goes to $1.6. I mean, that's like almost doubling the return. So you have to be aware of that. It's like, don't get too butthurt or jealous or whatever. You have no idea. You just know that everybody shows, typically 99% of cases shows their wins. They sweeten how it looks, let's say, and you don't know if they're playing around with $1,000 in that portfolio. Because it's like my most long-term portfolio. This year it's, I don't know, plus 10% or something, which is outperformance, and I'm happy with that. It's very, that makes up, what can it make up? Maybe 15% of my net worth, 15% of my almost total portfolio, since I'm pretty much all in all the time. So is that a fair estimation of, you know, how I've done? The thing is though, that's like I have some private companies that I can't, I mean, they've not gone up, they have not gone anywhere because there has been no trading, no private placement, etc. And I think they're worth a lot more than their price is fixed at. But still, it's like I try to make these videos and talk about concepts that's like can be applied for people that are not accredited investors. Because I participate in a lot of private placements, especially if I get full, 2-year, 3-year warrants. I invested in some silver juniors where it's like I don't particularly like the companies, but I know what can happen with silver juniors. And if I get 2-3 year full warrants, it's like I just need the silver sector to turn around within 2-3 years, and I'm gonna make money on the warrants alone, even if I sell all the shares. But that's not very helpful if you can't do that. So I try to talk about stuff that can be applied for anyone, because it's not very helpful if I only talk about cases or things where it's like, yeah, this is a great opportunity if you bought the only in the private placement, for example, or like concepts like that, or shows like, oh, this, hey, this is how well my portfolio did. By the way, warrants, added 40% to it. And it's like, and make people think that, oh, hey, I must be doing something really wrong because I'm not even close to that return. Whereas in reality, it's like, yeah, you would have the same returns if you participated in the private placements, which you can't. It just makes people feel dumb, let's say, because the returns get so supercharged in case some one expiration story works out with a lot of warrants. That's why I show the HODL portfolios, for example, quite a bit, because they have no private placements, they have no warrants, they have no leverage. So it's more of a realistic picture, which I think is achievable. And I showed that the last video, where it's like, yeah, 3-year return is like plus 45%. That's not something people typically highlight, if you know what I mean. Even though it's greatly outperforming the median junior, I think it might be outperforming GDX and GDXJ, even though it's in the junior sector, which has been much more crap than the larger indices, especially lately. But still, I think it's, sure, would I rather show, how much does my ego need feeding, if you know what I mean? I just think it's doing a disservice, because then people will maybe feel dumb or whatever, instead of just trying to show that, hey, the HODL portfolios, they don't have outrageous returns, but they are achievable with low maintenance, little trading, buy and hold strategy, without any warrants, without any options, without any private placements, and all of that. That's like, you should not bank on like, oh, I should get 200% every year because that's what all the highlights I see are. It's like 200%. It's like, again, you have no idea how small that portfolio might be, or what kind of risks they took, etc. Anyway, so then we have Cantex. I haven't really bought into this, but they put out some good visuals. Rob McEwen I mean, I don't think that's a huge investment, but I think Quinton has talked about this. So they put out, where was it? Cantex intersects an outstanding 89 meters mineralization. So Cantex intersects strong massive sulfide in its first hole drilling. So okay, they have promising visuals. There's apparently like almost a billionaire guy that's at the helm. What's his name? Okay, it doesn't load, whatever. No volume at all. I mean, that's kind of speaks to the market. This is an interesting one, at least. Okay, encouraging as visuals. Let's see what they bring, right? I mean, if this is the things, like I prefer to pay to get in post discovery, because the risk goes down a lot, even if you pay up 50%. If it's an early hole, I mean, an early stage hole, and it's good, it speaks volumes, just like Hercules Silver. Whereas, like we saw in Juggernaut recently, good looking visuals from Midas, but the assays weren't that good. So it got almost cut in half. And I participated in that placement just before with a 4-month hold, so I can do anything. I was like, was that a bad bet simply because it's down 40% maybe right now from where I bought? It's like, no, I mean, it's impossible to know. If the assays were as good as the visuals, let's say, suggested they could be, if you know what I mean, I wouldn't be complaining. I mean, if they hit like 3 barn burner holes, really good ones, and it's an obvious discovery, maybe I would be up 50% on the way to being up 500%. It's like, I can't just look at the result and say, well, that was dumb because it didn't work out. It's like, well, that's not helpful at all, because you never know which ones will work out or not. You can't just look at the results like, every single decision every single stock I made money on was a good buy. Every single one I lost money on, if even for a period of time, was a bad decision. I mean, okay, is that helpful? How do you know? Because that's like, well, if you know the future, you could have better returns. It's yeah, I mean, a waste of time to be thinking like that. All we can do is make the best possible risk-reward decisions while knowing that the future is uncertain. I don't know. Again, I don't know if any of these will work out from here. But I do think that some of them is like, I think there's enough blue sky that any one of these, if I held them long enough, if one of these announce a major discovery over the next 6 months, and I hold them for 2 years, I think they would pay for all the other ones that went to zero. Even perhaps like Hercules Silver, even though that's already 300 million, but still, I mean, who knows? That's the idea. But in the meantime, because I see it all the time, let's say you're bullish on all these. Let's say one fails, and you hear, oh Jesus, look at that guy. He was bullish on whatever stock it was. What you imply kinda is that if you're bullish on high risk, high reward stocks, you're bad if not everyone succeeds. So let's say blue sky for Alamira is 20 bagger, and here's also a 20 bagger and a 20 bagger and a 10 bagger and a 20 bagger and a 20 bagger and a 20 bagger. If you would have close to 100% hit rate on every high risk, high reward store with a blue sky of a 20 bagger or more, or 10 bagger or more, you know how rich people would be? There's no one that gets even close to that. If you only need one of these to work out, and you take advantage, meaning that, let's say Altamira makes a discovery and all the other ones don't make a discovery, drill dusters. Altamira pops 100% and you sell your whole position, even though it's like, yeah, it's not even close to being, fairly priced yet, let's say. Was that a good strategy? I mean, if one is supposed to pay for the many other stocks that went zeros, like if you only capture a double on these high growth potential stocks, which has theoretically 10 to 20 bagger potential over the next 2 years, I mean, talk about shooting yourself in the foot. You can't pay for much at all. And then just thought I would, covers like takeovers. I don't know which are going to be taken over, but it's like two that are, I guess beta and alpha plays. I think Snowline is more alpha play than Rupert perhaps, but still, both of these companies have world-class deposits, and I think any gold major or mid-tier would be happy to have Snowline Gold, Valley Deposit, Rupert Resources, Ickery Deposit, and like I've talked about recently, it looks like Rupert Resources is really setting itself up to being taken over. And we saw NICU Eagle get into Firefox. And then we have Snowline Gold, which already has B2 Gold, and that deposit just gets better and better. At the Valley Target, they have a absolutely enormous land package. They have enough of a land package for a major to be exploring for decades to come. So I don't know how. I think Snowline is too cheap if you include the land package plus their Valley discovery. But it's like I think these will be taken over one day. I don't know when. But that's the thing, which is, they're not super cheap, maybe any one of them. They are high quality, but I like the idea of like, okay, these projects are worth something. They have the grade, they have the size, and all of that. And it's like, from a beta perspective, I would rather have some lower risk, high quality beta plays with takeover risk that could happen at any time than just beta risk, if you know what I mean. These will probably move up and down with the gold price, or with the junior sector, I should say. But to have this in the back pocket, that's like at any point in time, there might be an announcement that they get acquired for a 50% premium, and you get a quick, boost like that, and the story is over. That's just great. Anyway, thanks for listening. Consider me biased as always. I hope these videos are helpful. And again, it's like I just said, I'm biased. I own shares of all these companies. Well, not Cantex really, not yet at least. But I think all of these have a shot of making discoveries or confirming discoveries, and I think quite a few of them might put out that news in maybe January or February, or somewhere along those lines. And depending on how good results are, if you're more risk averse, I don't think it's a big shame to like just be following these stories. And if you see some of them make discoveries, or put out discovery holes, even if they're up 50%, they might actually, from a risk reward perspective, be better buys than now, even though yes, I'm already invested in them, and some I can't even get out of anyway. But that depends on your risk profile. But I hope I've talked about it enough that after a discovery hole, the journey starts. It's not the end. The first 50 to 100% pop from a discovery hole, that might be the start of a 10 bagger or the start of a 20 bagger after the pop. Great Bear, I think, went up 20 times or 30 times after the actual discovery pop. And people who thought, oh nice, I have 100% return, they missed out on a 20 to 30 bagger, which if they held it through the end would have paid for 40 to 60 stocks of equal positions that went down 50%. You don't need many wins. And that's why I've said it's like Snowline alone and Hercules Silver and stuff like that. They have paid for a number of stories that I have a paper loss, or sold a paper loss and made it a permanent loss, etc. Anyway, Thanks for listening. Do your own due diligence. Don't invest money you cannot afford to lose, because there's nothing more sucky than needing to sell because you need money, even though, I mean, let's say this drops down here and everything gets 20% cheaper again. It's like you have to sell. That just sucks. Thanks for listening. Bye-bye.